Hello, everyone. I'm your host, Vaibhav Tura. Welcome to Wealth Visions, the podcast about public and private market investing. We sit down with industry leaders in private equity, investment banking, real estate, venture capital, and portfolio management to uncover the key factors behind their success. We discuss work-life balance, mindset, risk management, and the lessons you can apply to excel in finance and business. Today, we're excited to have a very distinguished guest, Mr. Axel Christiansen, who brings over 30 years of experience in sell-side M&A and corporate finance, specializing in supporting small to medium-sized businesses in Western Canada. Axel has worked across a broad range of industries, including HVAC, manufacturing, SaaS, distribution, and retail, facilitating successful sales to strategic acquirers, private equity groups, family offices, and independent sponsors alike. With a background that includes senior roles at Baker Tilly, Canada, BDC, and Van City, Axel is well versed in the intricacies of business transitions. He is a CFA charter holder, a UBC economics graduate, and has completed an MBA on a full scholarship. Axel has chaired the Business Transition Forum and has a wealth of knowledge to share on the art of business transitions and corporate finance. Axel, welcome to the show.
Hey, thank you for having me.
I'm going to be honest, that is hell of a lot of a background.
I'm going to be honest, it makes me feel old.
Really? It makes you feel old, but you still look very young and you still look, you're in good shape. And
I'm liking the way this is going already.
All right. So, I would love to start from the beginning.
Mm-hmm.
You were born in Hong Kong.
Mm-hmm.
You grew up in Philippines.
Yeah.
And then eventually, you went to UBC and then you got your CFA and you got into the industry. So tell me a little bit about those early years. What was it like growing up? And did you know that you wanted to get into M&A from an early age?
I think from a fairly early age. So my father was apprenticing with a shipping line in Hong Kong, learning all about shipping at that time. Then I was born and they shortly moved to the Philippines where he got into the forestry industry there. He was a full-blown entrepreneur, so there was no kind of entrepreneurial obstacle that he could not overcome, and built a very interesting forestry company there, sourcing mostly mahogany species in the Philippines, set up his own reman operations, would sell to large door and window manufacturers in France. And so, growing up, I was always around that entrepreneurial vibe, things going really well and then things going really terribly for a while, and the yin and the yang that comes with being an entrepreneur. Mm-hmm. So I think that's where I really developed enthusiasm for entrepreneurialism and kind of a respect for what entrepreneurs go through, mm-hmm. relative to those of us that have a day job. Philippines was not an ideal place to raise a family back at that time. It was martial law, the Marcos regime was in town, people were being kidnapped left and right. So it was time to find a little safer place to raise a family, and that's what brought us here to Canada. But Dad continued to operate the business, and so I actually worked with him for a few years, sourcing lumber here. Got my A grading certificate, which is probably one of my proudest accomplishments because it's so different from any of the academic things that I've done. But again, just the highs and lows of that business. My father made a good amount of money and was very well off, and then crashed and burned and was close to zero.
Wow.
And then build it back up again, right? And so that grit I've always admired in entrepreneurs. And so whereas I admired it, I also saw that roller coaster ride and recognized fairly early on I was probably not ready to take that ride in the front seat. But I wanted to be around that dynamic. And so that led me into a career in first corporate finance, where you're financing entrepreneurs, enabling them to go out and do the amazing things that they do. And then after about 20 years of corporate finance experience, migrating over to sell-side M&A as just a logical path. Sell-side M&A is a lumpy business, and so you generally need to have a good amount of experience to get into it. But you also need to be ready for the highs and lows of the remuneration structure. Mm-hmm. And so that's usually something we see people get into a little later in their career.
Since we're on the topic of mergers and acquisitions, in a world where there is lots of capital, in a world where there are so many businesses wanting to exit, so many acquirers, to someone who doesn't have a good grasp of what M&A is, what would you tell them?
Well, M&A, the role that I play as a sell-side advisor is really helping facilitate transactions. So we assist our clients with the lengthy, complicated process of selling a business. And that can be a multi-year relationship where oftentimes we'll meet people years before we actually get very actively engaged in helping them sell the company. And at that point in time, we're kind of doing an assessment of their business, maybe giving them some valuation feedback, and giving them suggestions of what can they be doing with their business in the 2 or 3 or 5 year run up to them actually transacting that business. That will help make it more interesting to buyers, make it more valuable to potential buyers, that kind of thing. So that's usually the start of the relationship we have with our clients. And then when it comes time to the transaction, that's where the activity really picks up, where we're doing more intense valuation work. We're doing reverse due diligence on that company. What do we like about this business that we're really going to bring out when we're talking to potential purchasers? What is a purchaser likely to be a little bit concerned about? Can we deal with those risk factors before we go out to market? Or if we can't, at least we need to be able to explain them and mitigate them in the eyes of the purchasers. We do a lot of work in figuring out who the right purchasers might be. So that is one of the biggest value adds, I would say, is not just throwing a deal at the wall and seeing what sticks, but being very direct and very methodical in terms of selecting who are you going to introduce this transaction to, and why are they going to be interested. So have they shown that they are actively buying companies? Are they buying companies in that industry? Are they buying companies in that geography? Are they buying companies in that size range? So that you narrow it down to a list of people who are highest probability to show some enthusiasm for the transaction. And then we put together the package. And that's, I think, one of our differentiators, especially in the small to medium size end of the market. If you're marketing a smaller deal, the holy grail is to get a large strategic or a very large private equity group or somebody big to pay attention to that transaction, because they're the most likely to be willing to pay as attractive a multiple as possible. And the primary way you do that is putting together material that is professionally presented, it's thorough, it's accurate. And when you do that, then you can start to draw the eye of these larger buyers, because they start to recognize, okay, this is not going to be a painful process, which it often is for them in the small to medium sized space. This is going to be a professionally managed process. I'm going to be able to get good information in a timely manner. I am going to invest my time in looking at what is generally a smaller deal for some of these bigger players. Yeah.
Let's talk a bit more deeper into what you just said. So you are helping these businesses prepare for sale, and it could take anywhere, like you said, a couple of years, to really pull all the data together, as well as finding the qualified buyer.
Yeah.
What are some variables we're looking at? What do sellers care about? Because it is their business. It's something they have really grown to love, grown to work on, and in terms of expectations and alongside the variables that you're looking at in terms of presenting it to the buyer, what are those variables, and how do you manage the expectations of the seller?
Absolutely. Yeah, I should first clarify, we're not super involved in that preparation phase, so that's usually a light touch from us. We're looking at the business and we're giving them some pointers and some ideas as to what they might be doing. If they want help with that, we typically refer them to consultants that specialize in kind of helping develop that plan and holding their feet to the fire to execute on some of the improvements that they might want to make in their business before they go to market. But in terms of some of the things we typically talk about at that stage, broadly, contextually, value is driven by the cash flow that the company is going to generate, right? And what buyers are looking for ideally is stable, predictable, growing cash flow. And so we encourage sellers to look at their company through that lens. What is it about my company that is not going to give a buyer comfort or confidence that the cash flow is going to appear on time and in the amounts that I'm committing? And can we fix some of those issues? So some of the usual suspects in terms of things that you want to be looking at is concentration risk. If you've got one client that represents 60% of your revenue, if that client goes away on Tuesday, this is a very different cash flow profile and a very different value profile for that business, right? So work on diversifying that client base. And so that's something that's super easy to say, but that usually takes years to do, right? So that's one of the reasons why you want to kind of start thinking about these things well in advance. The other concentration risk would be supplier concentration risk. If you've got a supplier that's key to the business, that's significant, that is not easily replaced, that is a challenge that you're going to want to deal with. Key personnel concentration risk. If there's one salesperson in your business that drives 70% of your business, that is a real risk factor, so you're going to want to diversify that. So those are some of the the usual suspects.
Mm-hmm.
The other thing is, are you concentrated in a single product line? Right? Is there one product SKU that maybe has a typical product life cycle that is driving most of your revenue? And you can see the decline coming over the next 5 or 10 years. Nobody wants to catch a falling knife. So
Right.
can you diversify into something that's got some upside? And just, are you in products that are interesting to the market or ones that are less so, right? So is there a recurring revenue type of profile that you can build into your business? Because that generally is more valuable because of its continuity. So there's a range of things, and every business is a little different, and the feedback will be a little different in each one. But the common theme is most of these things take some time to address and to get right before you're going to fully maximize your value.
Right. I think, the interesting part in, connecting the buy side and the sell side is finding that balance where the seller feels comfortable with the price, as well as the buyer feeling okay with the kind of price they're going after, because they both have different perspectives, right? The seller is kind of looking in the past based on the earnings and the growth, like you said, are the main drivers of valuation.
Yep.
And they're looking at the number in the past and coming up with a number that reflects, how much really their business is valued. But on the other side, the buyer is more concerned with the future of the business, what it's capable of doing.
Yeah.
And the price is based off of that.
Yeah.
So where is that balance? What kind of skill sets are we talking about in this instance? Does it all boil down to deal structuring and negotiation?
No, I think it starts earlier than that. I think one of the bigger value adds that an advisor brings to the table is the ability to manage their client. You're obviously trying to get the purchasers to be as aggressive as possible in terms of value, but as you've already touched on, both sides kind of have to align for a transaction to happen. And so you need to make sure that your client understands what a reasonable value expectation looks like, get them ready for what this process is going to feel like, because it's a long, grindy, can be very frustrating process. And so a good advisor is going to set reasonable value expectations, because client might have an expectation that's 3 standard deviations away from appropriate, right? You've got to adjust that, or you've got to just not take on clients that don't have reasonable value expectations. And then you have to prepare them just mentally for the emotional roller coaster that they're about to head on. Because if you don't, it can be a very, very difficult process, because they'll be frustrated at multiple points along the way if they're not anticipating some of the typical challenges that you come across in a transaction. And then, of course, the obvious job of the advisor is to get the purchasers enthusiastic about the transaction. That's a kind of a given as part of our role.
You are also part of an investment bank. Essentially, I mean, that's what you do, right? You are the middleman between the sell side and the buy side.
Yeah.
And you're communicating with lots of people. You're communicating with the buyers and the sellers, and you're talking with lawyers, you're talking with M&A tax people and accountants. This is really one of those industries where you have to communicate with lots of people.
Yeah.
Would you say that communication is a very important skill if you're trying to succeed in M&A?
Oh, absolutely, because you're trying to develop relationships with people all around the transaction, right? You have to have a good relationship with your client. They have to trust that you're working in their best interests and making right recommendations for them. The purchaser has to trust you, so that kind of spills into the material that you're providing them. I always want to really push to make sure that we're providing accurate material. You're not being overly aggressive in the way you're representing the company, because once they look at one thing and they say, okay, that's aggressive or that's not accurate, now they're starting to think, okay, well, what else do I have to worry about here? So it's really important to develop a relationship where they view you as capable and trustworthy, because then, as soon as the trust starts to leave the equation, you're going to have a very difficult time getting a transaction to close. And then with the lawyers, I mean, you're trying to inspire them to work as quickly as possible, but still have in the forefront of their minds the best interests of the client. Right? There's a balance between the best interests of the client and being pragmatic on issues, and you need to communicate a lot to make sure everybody's on the same page there as well.
Right. When it comes to, so now we're kind of transitioning into the perspective of the seller. Would it be wrong if I were to say sellers essentially care about 3 things? Number 1, how much am I getting paid? Number 2, are you going to take care of my company, or are you going to drive it into the ground? And number 3, are you going to take care of my employees?
No, I think that's very accurate. We
Okay.
find in most deals the sellers are not primarily focused on the maximum dollar, because we'll get several offers, right, and we'll spread them out on a spreadsheet, because there's usually 15 or 20 different considerations that you want to look at in terms of comparing offers, and we'll present that to the client and make a recommendation. Frequently, where we recommend the deal that's not necessarily the highest total dollar value, and it'll come down to things like a structure. One might be a more favorable structure, reputation of the purchaser. One might have a reputation for being really grindy in diligence. The other ones are very easy to work with. So what they present, you have more confidence that's what's actually going to materialize at the end of diligence. But what usually comes to the fore is what the entrepreneur is focused on is the other 2 points you talked about. Take care of my people. I'm not going to sell to somebody that's going to shut this down and fire everybody, because these folks got me here, and that's not the thank you that I'm going to give them. And B, legacy is important for a lot of folks. They want to, even if they're out of the business, they want to be able to turn and point to their friends and family and say, I built that, and look what it's doing now, and it's still called Johnson and Company, right? So I think the latter 2 points are probably more important than value for most sellers in the size segment that we work in.
That's fair. In terms of risk management and risk mitigation, is such an important part of any kind of investing, whether it's public markets, whether it's private markets in this instance.
Mhm.
What are some steps business owners can take to mitigate their risks?
I'm mitigating the risk in the context of a transaction. I think doing that work up front to make that business as saleable as possible, right? So if you've got all your ducks in a row, you've dealt with concentration risk issues, you are nicely growing the revenue of your business, you've got good financial reporting so that you can get through a diligence process and provide the myriad of different reports that they're going to want to see through a diligence process. You've got your business well documented, it's systematized, all those kind of things. Then you kind of really start to reduce the risk of not having a favorable outcome when you sell the business. Yeah, those would be the primary things. Other than that, people use insurance to cover themselves, both the company and there are forms of insurance that can help with mitigating the risk, reps and warranty insurance in a transaction. So mitigating the risk that there's any sort of claims or pullback of any of the proceeds you receive out of the sale. So there's insurance mechanisms to protect yourself. Yeah, those would be the primary things.
And from the buyer's perspective?
From the buyer's perspective, oftentimes it comes around structuring, right? So especially and that ebbs and flows depending on where we are in the cycles, right? Coming out of COVID, everybody was euphoric and had to do deals.
Right.
And
the interest rates were low.
Interest rates were low, so people didn't see a lot of risk, and therefore didn't factor into the structuring. Now we're in an environment where people are worried about the economy. Rates are considerably higher. People don't believe next year's forecast with the same enthusiasm that they did a couple of years ago. And so they're using structure to protect themselves. And so that typically comes in by way of the form of an earnout or some sort of contingent consideration. So they said, okay, well, we'll pay you for what we believe the core business is, but we're not fully going to believe you on the forecast. If it materializes, we will pay you. But if it doesn't, we're going to structure around that such that we're not overpaying for business that's not going to deliver on that forecast, because there's more perceived risk around that forecast in the current environment.
Right. Just going a bit more deeper into the structure, what is the amount of debt that could be seen as comfortable in a leveraged buyout? Because sometimes it's highly leveraged, sometimes it's beyond 80%, and sometimes there are even transactions where it might be all cash.
Yeah.
So in terms of that, where do you think the sweet spot is? Do you think it is about just having a number, or is it more about your ability to manage all of that?
It varies depending on who the buyer is, and it varies depending on the profile of the company that's being sold, right? So a company that's highly cyclical, and so you can't rely on kind of consistent earnings year over year or even multi-year periods, you're generally going to see a pretty low level of debt being applied to that business. The banks aren't going to be comfortable putting a huge amount of debt on that, and the buyers generally are not going to want to put themselves in a situation where they can be in distress a year from now because they've hit a cyclical down cycle. So the profile of the cash flow will be the one driver. The other will be the buyer themselves. Some are, they're strategics that are very flush with cash, so they just want to deploy that cash and get some return on it. So they'll generally use very little debt in those scenarios. Private equity groups will tend to use leverage more and do a little more financial engineering. I'd say the cookie cutter structure is kind of 50-50 debt to equity. We see that on a lot of transactions.
Okay.
The other limiting factor will be the seller, right? Because there are some out there that like to use a lot of financial engineering, and we're going to do 80% debt and 20% equity on this deal. As a seller, you'll frequently in our end of the market see sellers say, I'm not on for a buyer that's going to structure the deal that way.
Right.
That's a lot of risk. They've had no debt usually for a decade or more before they sell, right? So they're like, I can't contemplating having that much debt on the business. And then second, they might be carrying a vendor note or something, and they're thinking, I don't want to be last in line behind 80% debt on this company. And my vendor note is really at risk in that scenario.
Right.
And then it's concern around the employees as well, right? I didn't build this business for 40 years for it to be insolvent 2 years from now, right?
That's true.
Yeah.
Do you think most of them would say, I don't want that much debt? Or is it more about, do you look more at the ability for the buyer to take care of that? Or is it more about what the seller wants? That's the first thing.
I think it's primarily driven by the seller, right? Because back to the key points of focus for the seller, take care of my staff, legacy, right? And a highly levered deal puts both of those things at risk, right? So that's where you're going to get an automatic reaction that maybe that's not the approach that they want to see.
In terms of negotiation, would you say that this is one of those industries where the seller has more power than the buyer when it comes to purchase price and things alike?
That's another thing that'll ebb and flow depending on the dynamic of the market, right? So there's periods where it's very active, lots of money chasing deals, and we've been in a good environment for quite a while now with respect to that. And so the sellers is a seller's market, and they generally have more power because we'll have multiple offers on any given transaction. In this environment, it's a little less so. I mean, it's still the seller's market, but not anywhere near to the degree it was, a couple of years ago when everything was going crazy coming out of COVID. So now rates are higher, bankers are a little bit more reserved. Not every deal is going to get funded. You're generally seeing buyers a little more cautious, taking more time and diligence, maybe a few less offers on any given transaction. So still a seller's market, but grindier, and your negotiating power is not the same as it would be in kind of peak market conditions.
That's fair. I would love to get a bit more into your experience in the Vancouver Business Transition Forum. You have chaired it twice, and it's the largest transition-focused conference in Canada. What are some important lessons that you've learned from that experience?
Yeah, that's a fantastic conference. Like we do our own little seminars on a regular basis, but that's informal, and we get 20, 30, 40 people out and trying to give them a multi-directional, multidisciplinary view of what it takes to sell a business. But the Business Transition Forum kicks that into high gear. So these are conferences that take place in Vancouver, Calgary, Toronto, Halifax, now in San Diego, I think, and I'm probably missing a couple of markets. So it's national and moving into the U.S. And it's run by folks that run conferences for a living. So it's very professionally done. And usually kind of Vancouver gets 300-400 people, kind of a 60-40 split between entrepreneurs and advisors. And so if you're an entrepreneur, and it's a full day session with breakouts and everything you want to hear about with respect to transitioning a business is covered at some level at those conferences. And you can meet pretty much every advisor you're going to need for a transaction there, and several of them in every category, right? So if you're wanting to kind of accelerate your learning curve,
good place to network.
It's a really good place to go out there and do that. And then it's not going to give you all the information you need to be ready and prepared for that, but it's a really accelerated start to the process.
Is that a yearly event, or how often does that take place?
Yeah, yearly, and I think been going for 6-7 years now, I think. Yeah.
Okay, very cool.
Yeah.
So in terms of the buy side, what are some risks, what are some mistakes you have seen lots of people make, whether they're private equity groups, whether they're independent sponsors, whether they're family offices or venture capital people trying to acquire a certain asset? What are some mistakes that could be mitigated to better transition the process of post-acquisition sale?
I think the primary one is don't change too much too fast, right? So you've got a business that is doing a lot of stuff right. And a lot of the businesses we sell, there's definitely room for improvement. Like these folks have been running them for 40 years.
Mm-hmm.
They're content. Most of them do absolutely no sales and marketing because they're happy at the level they're at, right? So you can see immediate potential there to ramp the business. They maybe aren't fully up to speed on the most common and the most current tech that they could be using in the business, that kind of thing.
Mm-hmm.
So there's lots of touch points where you can make improvements to the business, but they are really solid, nice businesses anyway. They've been around for a long time, deep customer relationships, making good money, complement of really good staff, all that kind of stuff, right? And so what sometimes purchasers, the trap they fall into is they're all excited about the upside potential, and and they've got this new toy, and they start making all sorts of changes really quickly, right? And the market and the customers and the staff can only keep up with changes to a certain extent, and that will vary from business to business. But if you've got a kind of an old school business where people have been doing it the same way for 30, 40 years, you should probably just sit still and just take inventory of how it all works for 6 to 12 months. And then B, when you start to make those changes, those need to be very small and incremental initially. And then, as you get comfort that everybody can keep up, you can start to be a little more aggressive with those changes. Because I've seen situations where people put through all these changes and, it ends up working out very poorly for the business.
For its people as well.
Yeah, even though on paper they all make good sense, right? The spreadsheet looks great, but there are human beings involved here, and they're a little more complicated.
Right, and that's a kind of thing people seem to view private equity as. You hear the news, okay, private equity might be acquiring my business. A lot of people seem to get scared. Oh, private equity is known for kicking out its people and doing these crazy restructuring financially and qualitatively as well.
Yeah,
is that a thing that's being done even in today's world?
I mean, I would not lump everybody in one category of private equity because there's so many different shades of gray within private equity and so many different areas of focus within private equity, right? So you have some groups that are private equity, but they're all born of entrepreneurs. Like it's a group of entrepreneurs that got together and now they're buying and fixing companies. And so they understand that entrepreneurial dynamic. And in the small to medium sized space, most of the private equity groups that are pursuing deals in that end of the market tend to be more entrepreneurial. So you don't get the classic, what you hear about is, finance guys that have no clue about operations, running a spreadsheet and doing terrible things. I just don't see that in terms of the buyers that we typically work with in the private equity space. They tend to have good entrepreneurial understanding.
When it comes to communication, considering you're really kind of like in the middle and facilitating information from the buyer's perspective and the seller's perspective to eventually come to a mutual agreement, um, when it comes to the plans that the buyer has for that specific asset, for that specific business, the changes that they want to do to the model, the things that they want to keep the same, and the things that they want to take out, whatever their post acquisition goals are, um, how much of that are you communicating to the seller? Do you want to make sure that the seller knows what the business might turn into, or what are these changes that the buyer needs to make or wants to make? In terms of that, what's the situation like?
Oh yeah, absolutely. I mean, a lot of our discussion before we go to market with the sellers is around what are the growth opportunities in this business. And the company might be pursuing some of them, but not all the way up the curve in terms of that growth opportunity. So you can say, okay, we've been going at this for 2 or 3 years and we've made nice progress, but this is where that chart could go if you really actively pursue it. And then there are other opportunities that haven't been pursued at all that would make a lot of sense for the business. But then again, the vendor is 70 years old, doesn't want to pursue it. Growth is great, but growth comes with risk and growth requires energy. And if you're at 70, it's like, I'm completely happy making my 3 million EBITDA a year. Thank you very much. I don't need 5, is oftentimes the mentality. So we'll talk to them about what the growth opportunities are.
And what the acquirer is looking to do.
Yeah, and they will have a good understanding that the acquirer is not buying this company just to keep it steady state. They want to take it somewhere else. And oftentimes the sellers are kind of happy to have that dynamic because they recognize that many times the seller will say, I'm the biggest hurdle in this business. Like I'm the thing holding this thing back. And one of the benefits to them of selling it is that it's going to be in the hands of somebody that can now have it fully actualize what the business is capable of, which is also a positive for the staff, right? It means opportunity to learn, opportunity to progress to higher positions within a growing business, as opposed to being in a business that's just steady state. So most of the time, the sellers view that as a positive. And then once they get in, the buyers can take over and start trying to execute on it. But as I say, not too quickly. I wasn't involved in a transaction, but I know of one where there was sort of a management buyout that was supposed to be happening, but at the end of the day, the strategic was willing to pay, an extra $100,000, like an insignificant amount of money.
Wow.
And
does that ever make you wonder, why are you paying so much? Like, what exactly are you acquiring this for? Do you get into these synergies, or what's your plan with that, or do you not get into that?
Oh, no, with the seller? With the buyer?
With the buyer.
Yeah, oh, no, in the buyer, we actively want to understand what the synergies might be. It kind of helps us in our negotiating process, right? Because if we can appreciate that they can save a whole bunch of expense if they bring these two companies together, or, I sold a software company where the core software was extremely good, but their sales and marketing channels were not very strong. Selling to a company that had huge, robust, and very well-developed North American sales and marketing channels. So you want to understand, what can this business look like in the hands of each individual buyer? Because then you can help negotiate, what is the true value of that business? Because you don't want to just purely value the company on a standalone basis. You want to have an appreciation of what it's potentially worth in the hands of that individual purchaser, and negotiate to get some of that upside on behalf of your client, and not have it all accrue to the buyer.
Right. In terms of debt repayments, in terms of post-acquisition repayments, because obviously, there are deals where you get the money straight up, and there are deals where debt repayment is on a specific time horizon.
Yeah.
In terms of that time horizon, how long what's the sweet spot? It could go for 10 years, it could go for beyond that.
Yeah.
It could be as short as 5 years.
Yeah.
What do you think is the sweet spot is? I mean, I'm assuming it's all the seller's preference.
Yeah.
But where do you feel comfortable? Okay, this buyer is comfortable with not only acquiring but also paying back the debt, judging from the acquisitions they've done in the past.
Yeah. So it'll vary. Generally, we try to keep that repayment period, like on an earnout or on a vendor note, relatively short. The concept being, the purpose, we don't want to be a financier to the transaction. We want to give the buyer comfort that the owner is going to have skin in the game for a few years over that transition period. He's going to be available and motivated to come back and help and make sure the business transition has gone well, and assist in potentially growing the business over a 2-year period or maybe a 3-year period. We don't want them kind of carrying debt over 5, 6, 7 years when the vendor is out of the business, not involved, and now is just a lender. That's in our view is not really the role for the seller in a transaction, right? So we're happy to do it to provide comfort that the seller has comfort that yes, I'm going to take risk, and I'm going to be behind the senior debt, and I'm comfortable that the business is going to be able to pay me back, and this will motivate me to support you guys over the next 2 or 3 years. That is perfectly good. A 10-year vendor note, no, thank you. We're not a bank, right?
Yeah. I mean, we talked a bit about structuring. We talked about vendor notes. We talked about banks. We talked about cash. What are some other parts to the structure? I mean, obviously, there's mezzanine, there's senior, there's junior capital. In terms of those variables that you can use to make up the structure, what are some of the variables that are being used in the industry today?
It's usually fairly clean. Like the banks are pretty aggressive in terms of being able to provide cash flow financing. So there's not a lot of room for sub-debt mezz. I was in sub-debt mezz for decades before switching over to sell side. And that window is a little narrower than it was back in the day, primarily because the banks can go to 3, even 4 times in good market conditions on a cash flow basis and pretty low cost. And then the equity is usually coming from the purchasers. So either if it's a family office, search fund, or private equity will provide the equity component. And that, for the most part, coupled with a vendor note or an earnout, which will ebb and flow depending on where we are in the cycle, will make up the capital structure for 90% of transactions.
In terms of risk from the buyer's perspective, we briefly touched in mitigating the risk from the seller's perspective. What are some things that the buyer could do in terms of the structuring and financing?
Structuring, well, earnout structure. So don't pay for value that you don't receive, right? So that would be the biggest way to kind of mitigate risk. They can use reps and warranty insurance to make sure that if there's any misrepresentations that they can be made whole. If you really want to eliminate, reduce risk, MES or sub-debt MES is a good mechanism for that, because that is a form of financing that's generally paid back. You can have highly tailored payment structures where you're paying back as a percentage of EBITDA that's generated every year. So there's not a set repayment schedule. So that gives you kind of the shock absorber if results fall off, then suddenly your debt burden becomes a lot lighter because you've got that very flexible form of debt in your capital structure. Not taking on too much debt, right out of the gates, using more equity than debt will automatically lower your risk. And then making sure you're doing a good job of due diligence, so that you understand the risk factors that you're onboarding.
A lot of people, seem to not comprehend how important due diligence is. I'm referring more to independent sponsors, people who are doing perhaps their first acquisition, or even if it's their second or third deal. They obviously understand that it's part of the M&A process, and you have to make sure that you know what you're buying. You have to understand the legal, you have to understand the commercial strategy and all these things. In terms of due diligence for the bigger players, I'm talking about, private equity firms that are beyond, 500 mil in AUM. How much effort and how much weight do they give to due diligence and doing those kind of deals?
So we don't deal too often with private equity firms that would be in that size range, but generally the private equity firms that we deal with have a very kind of disciplined process around due diligence. So they want to look under every rock. It's a little bit like selling to a public company. A very high level of rigor around the diligence process, which you can understand and is good, but there's a limit to that, I would say, because if you're buying a small to medium-sized company, the private equities might be used to buying much larger companies, and then when they gear down and start looking at something smaller, that might be a nice bolt-on for them. I think it's important that they understand they have to adjust that process a little bit, right? It's important to do a good level of diligence, but there's only so much information that a small to medium-sized company is going to be able to produce and generate. It's not the same as dealing, like if I'm selling an $8 million business or I'm selling a $50 million business, typically it's very, very different in terms of the sophistication of the financial reporting and the ability to generate meaningful information. And so there has to be a bit of an appreciation for that, because otherwise you're going to exhaust that smaller seller, and they're going to get very frustrated and they're going to pull out of that process, and your success rate in buying that type of company is not going to be very high. If you try to kind of take that Fortune 500 diligence methodology and directly apply it to a smaller deal. So there has to be an understanding that you're in a bit of a different market, and you need to focus on the key diligence areas and do your work there. But what are the 2 or 3 real risk factors, and let's drill down on those, as opposed to that carte blanche. Let's look at absolutely everything in gory detail. Yeah, and I'd say generally diligence rigor is increasing, not declining. Like we're seeing a lot more quality of earning requirements in transactions, where typically you wouldn't have seen that in smaller deals, 5-10 years ago. So I think people are doing more diligence, and part of that's just where we are in the cycle as well, where people are a little more nervous about what the economy is doing. You'll see holding the stick a little tighter in the diligence process.
Can you explain a bit more what you say when you say smaller deals? Because small for you might mean big for other people, right?
Yeah.
So what kind of range are we looking for when you say small?
So we generally represent companies that are going to sell for anywhere between 5 and 50 million enterprise value.
So this is like more lower middle market.
Yeah,
right?
yeah. Micro for the U.S., lower middle market here in Canada. And the vast majority of our deals are kind of in the 10 to 30 range. It's kind of our sweet spot where 80% of the transactions that we do would fall. Yeah.
And these people, by that I mean your clients from the sell side and the buy side, are they all Canadians? Like, are you only dealing in Canadian businesses and Canadian acquirers?
We're selling Canadian businesses. So Fort is national. Relay right now, we're primarily covering Western Canada. We're looking to build capacity in both Calgary and Toronto, so that Relay can be national as a complement to Fort as well. So for Relay, it's Western Canada. And so the sellers are coming from the Western Canadian market, and then we're selling to buyers across North America, sometimes even outside of North America.
Very cool. You are dealing with different kinds of industries, different kinds of businesses. In terms of deals that come across your table that are different industries, and there's lots of diversification there, how do you manage to face those challenges when it comes to the complexities of each industry?
I think that's one of the joys of the job is that you're peeling back the veneer and getting to understand how these different companies work and what some of the value drivers are and some of the risk factors are in these different businesses, both from an industry perspective, but also from an individual company perspective. Both me and my colleague Grant are fortunate to have been working transactions for a long time. So we've generally seen most industries at some point in time. So there's a good understanding of what do we need to be looking at in terms of drivers for any given company that crosses our desk. But every company is slightly different, and so that's where the fun is. It's just understanding what is the specific risk profile of that one company, and then what can we do to make that as appealing as possible to purchasers.
If a purchaser came to you and you were to, obviously ask them what kind of industry do you focus on, and if they were to have a similar answer that we are sector agnostic, would that throw you off a little bit, or would you be more concerned? Hey, we should look for a purchaser who is only focused on one industry because they would, naturally know a lot if they just focus on one industry versus they are, kind of like a conglomerate model and they just want to buy whatever that seems attractive.
Yeah.
Is there a difference in that, or do you not put them in the same category?
Oh, no, I think I've sold a few HVAC companies. So if we go to market with an HVAC deal, there are a few aggregators that are HVAC specific. So I think those would be the low hanging fruit, the ones we really want to approach. But we would also include kind of broader acquirers for whom HVAC is one segment of what they're interested in. So we wouldn't want to exclude anybody, but we definitely would have a higher expectation for the specialists because they truly understand the business. And then if they showed no interest in this deal, then we'd have to ask ourselves, okay, what do these guys know that we're missing on this transaction? Yeah.
You've been in sell side for quite some time now. Have you ever thought of getting into the buy side? And, obviously you understand the impact it has on one's life when it comes to acquiring a business for yourself with, a group of entrepreneurs and kind of being in that space. Have you ever thought about yourself getting into buy side and becoming kind of like acquisitions holding company, to say?
No, I think again, just not wanting to take that level of risk. I think. I mean, yes, I could raise other people's capital. Twofold. I mean, buy side for most of the last 10 years has been harder than sell side. Right? There's been a lot of money chasing deals, so it's challenging, and so the ability to buy transactions on reasonable multiples, that's not an easy job in the environment that we're in. And then buying and operating a company, I thought about that a number of years ago, but you need a certain profile, and you need to, especially if you're going to be an operator. That is a skill set that many people don't appreciate how complex that is. I've managed people at certain points in my career, and I quickly recognized that is not my passion nor my strength. And so where that's not in place, you don't want to go down that road, I would say.
Usually people might not assess what their skill set is and all. And I think it's always good to look at your skills before moving forward and understanding what you want to get into. And even when you're looking for jobs, I think it's good to not stay in a job where your growth curve starts to flatten, but really thinking about how is this going to help me in terms of where I'm going and what my goal is, where my end, place is.
Yeah, oh, absolutely. I mean, I've changed jobs a few times over my career, and every time it's been really positive, right? It's invigorating. You learn new things. It kind of keeps you fresh. So I don't think you want to be anywhere forever. But that being said, you don't want to kind of be on the 1.5, 2 year cycle either, which you see a little bit more often these days. And at this point in time, I love what I'm doing, right? So if it's not broken, don't fix it. I really enjoy the work, and I enjoy being around these really successful entrepreneurs and really understanding, their story and what they've built, and then being able to help them monetize that is just altruistically really rewarding as well.
I mean, what more do you want? You're happy and you love what you do.
Yeah.
And I mean, that's what I would call success, Yeah. And I mean, we often talk about wealth, and we often talk about success as being tied to wealth. In terms of true wealth, what does it mean for you? I know that you're an avid traveler. You've been to over 70 cities. You've got 2 children. And what does true wealth really mean to you beyond
So wealth to me stems from my experience with my father, who lived a real roller coaster life, right? Made a ton of money, lost a ton of money, made a bunch of money, just up and down and stressed and wouldn't believe. I mean, he passed on when he was 72 with strokes because, I think he lived a very high stress, smoking, drinking, you know, temperamental existence. And so my response to that is that I've always viewed wealth as safety and security, right? So to me, wealth just affords you a safety net and the ability to breathe. And okay, if this doesn't work out, I'm okay. It's not buying stuff and I've always tried to instill that in my kids as well. All this stuff, your possessions possess you. Everything you own requires upkeep and is going to cost you more money. The investments account is my favorite asset, and for me, it's always been viewed as security and an ability to at some point pass something along to the kids to hopefully build on as well.
You've been traveling a lot. You
Mhm.
love to travel. You've been to over 70 cities.
Yeah.
In terms of getting that bigger perspective, going to all these places and seeing the people and understanding different economies.
Mhm.
How's that played a role in your life in terms of your corporate and personal life?
Oh, yeah. I think that's the one area where I will spend money. I like to spend money on experiences,
Mhm.
and I think that just stems from being born in Hong Kong, growing up in the Philippines. You immediately kind of had an appreciation that the world is different than it is here in Canada, and so traveling helps you understand how all these different places are different culturally, and just the history that some of these places have that we don't have in this country. So it's twofold. One, you look at a lot of places in the world that you go to, and you're like, we are so lucky in this country, and we're fortunate to be here, and things are fantastic.
Mhm.
And then on the other hand, you look at some of the things, and you're like, okay, well, we keep telling ourselves we're the best place on earth, but there's also a lot of reasons why that's not necessarily true either. So it just gives you a broader understanding.
Mm.
And there's so much conflict in the world. I think if people traveled more and understood each other a little bit more, that might decrease as well.
World might be a better place.
Yeah, yeah, yeah.
Right? And yeah, I definitely understand, having that gratitude and like feeling happy with what you have rather than
Mhm.
things that you don't have. And, traveling and seeing all these places definitely gives you good perspective of the country that we live in,
Indeed.
And I mean, really, we really, I love to talk a lot about gratitude and, that's definitely the trait of highly successful people too. And it's a good thing to practice that, and it's a good thing to be thankful for what you have rather than what you don't have, right?
Oh, indeed, because that's a never-ending treadmill, right? Some of
Hmm.
the wealthiest people in the world are not happy because somebody has a yacht that's 6 feet longer than theirs, right? It just never stops.
Hmm.
So,
So
being
true.
happy with what you have is a gift.
Hmm.
Yeah.
Yeah, and you briefly touched the point of how you have two kids and you want to tell them, possessions is not everything there is to life.
Mhm.
What are some other things that you want to leave your kids behind in terms of financial wisdom and in terms of other areas to life?
Oh, gosh, my kids. So I guess one of the things I got from my father was the work ethic. He always worked extraordinarily hard. So just being around that, that ability to kind of work through any challenge, that's certainly something that I've wanted to kind of demonstrate to my kids, and embed in them an enthusiasm for taking on that challenge,
Hmm.
right? And so they've so far so good. That's been a good thing. It's not what you make, it's what you keep. So I've wanted them to be relatively frugal, but not so much
Hmm.
so that it's really restrictive on their life. My eldest son's a CPA, so
Oh wow.
he is more frugal than I am. So my job with him is to loosen him up a little bit.
Okay,
So
that's fair.
yeah, the youngest was different. He was all about fancy basketball shoes, and
Okay.
he's now moving in the right direction. So
Hmm.
just being financially responsible,
Hmm.
and then just focusing them on what's important in life. And I think they're both kind of understand that stuff is not it.
That's good. Do you have any other advice to entrepreneurs who want to get into M&A, have been thinking about wanting to start acquisitions holding company or wanting to start a private equity fund, very ambitious entrepreneurs,
Mhm.
or even people who want to get into investment banking and work in mergers and acquisitions?
Yeah.
Perhaps if you could go back 20 years, is there are any advice that you would give to your younger self?
So investment banking, it's a terrific career. It's super exciting. It's super interesting work. It can be lucrative if you do a good job at it. So those are the big positives, and it's something different every day. And it's all highs and lows, right? So, it requires a pretty diverse skill set. You need to have good analytical skills, but you also have to have good personal skills, and the ability to sell. So that's a lot of fun when all that comes together. It's high stress at times. The compensation oftentimes is highly variable. So if you do a lot of deals, you make good money. If you don't do any deals, you make no money. And so that's something that's a barrier to entry to younger people. A lot of
what
time.
you kill, right?
Yeah, exactly. So if you got a mortgage and 3 kids, that might not be the time to consider this. Maybe that's something you get at a little later in your career.
Right.
And the other thing is, in here, there's not a lot of seats, so it's a pretty narrow pool for M&A advisors and investment bankers in Vancouver and BC.
In terms of the advice that you want to give to yourself, if you could go back 20 years, what would you say to yourself?
Oh, what would I say to myself? Oh gosh. Maybe I would have jumped into M&A sooner. As a finance person, being generally conservative, there's an apprehension around making significant moves. But I think that would probably be the advice I'd make. If I jumped into this another 5 years earlier, it'd be 5 years even further along in this. And I really enjoy this work. So I enjoy the corporate finance, absolutely. But there came a time when sub debt and mezz was really kind of constrained. So you were really working against headwinds in the marketplace, and then switching over to sell side M&A, suddenly that was a tailwind and just made a significant difference. So could have been running with a tailwind a little sooner.
That's fair. I mean, I always love to learn from people's mistakes and people's experiences. There's always the thing that you should learn from your mistakes, but there isn't a rule. Those mistakes have to be yours.
Yeah.
Thank you so much for doing this. And I learned a lot from the experiences you've had in the past, and it was very good to explore these M&A themes. And thank you so much for your time.
Oh, happy to do it, and good luck with the podcast.
Thank you very much.